Before I jump into this week's discussion, which will be a short one this week because there really is only one big theme, and that's inflation and the Fed. That's really the only story in town. But before I begin, last week I had put a video up about internal combustion versus electric vehicle or battery electric. And the main thesis was that internal combustion is far from over, that it has a much longer runway than what's being predicted. And I ended with an analysis, not so much an analysis, but just a sort of an overview of where I think Tesla would be going in terms of its growth rates and its margins. And in the comments section, you'll see that there was a lot of disagreement and a bunch of points listed as to where they disagree. I'll have a video up this week addressing each of those points. Everybody sort of had the same, they were in the same neighborhood in terms of the points that they were providing. So I'll use Tesla's financial statements and data from external sources to answer each of the points. And there's about 3 or 4 main themes that just kept repeating. Like everybody who put up their rebuttal had in and around the same concerns: the growth rate, the margins, things like that. So I will put that'll be up either Tuesday or Wednesday, but I'll go point by point through each one and presenting the evidence as to why that's backing up why I believe that growth rates and margins will be what they will be. So I'll try not to mention too much related to that as we go through this, but there is some overlap when we get to looking at the elements of inflation and whether or not the interest rate can solve that problem, because policy is working against right now. Global policy in some areas is working against lowering inflation, which makes the interest rate even more dangerous. So let's have a look at where we ended. The row across the top, this is the year-to-date high. All of them on Friday. Every single rate is at the highest it's been all year, except the 30-year. It's at 3.2. On May the 6th, it hit 3.2. It hit 3.2 again on the 10th. Since it's a tie, well, we were already there May 6th, so it's not really the highest of the year. It's tied for the highest of the year, but every other rate is now the highest, and this is the highest rate that we've observed on each of the tenors, on each of the rates itself over the course of the year, in both money market and capital market rates. The blue down here is Friday on its own. So when we look at something like the two-year at 3.06%, 23, it increased 40 basis points week over week from 2.66 to 3.06. 23 of that 40 came on Friday alone. So over 50% of the move in that week came on Friday alone. When we look at the 10-year, it moved 19 basis points. 11 of those came on Friday alone. So the market really reacted to Friday, and the S&P was just down the whole day. So we want to understand what the market was seeing in the CPI, and are they paying attention to the right numbers? Is it misleading? We'll look at a few categories on that one. The yield curve flattened pretty much across the board here. The 5 to 10s is inverted, but the 5 to 10s is not as important as the 2 to 10. That's the big one that everyone watches, and we are now sitting a few basis points above an inversion. June 15th is the next Fed meeting. This is the only thing that matters, is Wednesday at 2. They had been very vocal about 50 basis points, and on the last meeting and the last press conference, very vocal about the 75 basis points being off the table. But we got to put the 75 back on with a small probability of 10%, because that was the conversation. If that's the conversation, it's going to find its way into the futures. The Fed fund futures are being priced in. So we have to consider it, because we know the Fed looks at what the market is pricing in. And does consider that. But right now, the base case here is 50 basis points at this meeting. If they are going to go 75, this has been a very measured central bank They've projected everything in the policy statement, in the press conference, and in the minutes, and they've gone along with those projections and those forecasts of what they would do. As we read in the minutes, they did exactly what they said they would do. I don't know that 75 would be on the table, and if it is, I would seem to think that 50 would happen this week, with the projection that 75 is a possibility at the next meeting, unless inflation subsided or unless the data suggested otherwise. I don't know that they would go 75 after projecting out 50. But I still can't ignore the fact that it's a possibility. The Fed funds futures, what are they telling us? Right now we have, and I'll write up here, we have 75 to 100. And if there is a 50 basis point increase, that means you have a rate of 125 to 150, and typically it will target the center of that range, so we would expect 137.5 or 1.375%. July Fed Fund Futures is 98.54, which implies a federal funds rate of 1.46. So it's on the upper end, close to the top end of that range, which sort of hints at the fact that the market is going beyond the 50 basis points and pricing in some probability of 75. Looking at the end of the year, because the annual terminal rate is going to matter, where are they going to end the year at? Fed funds futures at 96.915, which suggests a federal funds rate of 3.085%, going out to 2024. 96.6, which is a 3.4% federal funds rate. Okay, let's look at our real yields. Some interesting stuff here. All the real yields are year-to-date highs as of Friday. All of them across the tenors, the 5 to the 30, are all positive now. And again, in blue is the move that happened just on Friday alone. So Friday alone, 13 basis points was enough to bring, because we're at 12 on the positive side, it would have been negative otherwise, other than that day. So Thursday, the 5-year real yield was still negative. Now we're positive. And I have been asked, why do real yields matter? Because I did say that the higher the real yield goes, it is a negative for stocks. It's a headwind for equities. And why is that the case? There's two reasons. It does increase the discount rate, but there's an interaction between the real yield and the level of economic activity. So it does affect cash flows as well. So let's start with just a simple statement, and let's look at cash flows that are not risky, and then we'll move to risky cash flows, because we have to do some work when we're forecasting risky cash flows. But let's say that we have a series of cash flows that we can observe, and we will discount these at a real rate, and we'll assume that these are real cash flows for now, and we'll get some present value from that. Well, if you have real rates that are negative, which is what we've had for a while, your PV will be at a premium. Meaning that the discounted cash flows will be greater than just the sum of the cash flows. Because if you're discounting your second cash flow, and this is a negative real rate, you'll end up with a present value that is higher than that particular cash flow. So higher real rates will also work in reverse and lead to a lower present value. So once these turn positive, this cash flow, this discounted cash flow, the sum of all the discounted cash flows will then be less than the sum of just the cash flows. So you're going from a premium position on the discounted cash flow over the cash flows to a discount position. Let's extend this now to risky cash flows, because we have to account for an interaction effect here. And how we get real cash flows, let's say you're forecasting for a company, but you're not sure what the price of the products that you're selling are going to be. You're in charge of a division, and you have to give a 5-year forecast, but you can forecast quite well what your increase in productive output will be. You know that every year you can achieve a certain level of production, so your quantities will be fairly good projections, but you're not too sure about your pricing. So what you'll do instead is you'll forecast real cash flows. Is you will forecast your quantity times price, which is your revenue. You'll forecast that in year 1. Year 2, you'll forecast your quantity, but you will keep the same consistent price. You will keep a base year price, and that is forecasting real revenues. We got to get to cash flows though, not revenues, because we discount cash flows. So when you're discounting or when you're coming to cash flows, you're going to reduce it by your costs, your wages. You'll incorporate your depreciation tax shield in there, and you'll come up with some measure of real cash flow. Your cost of goods sold, you can't just simply multiply it by a constant number, because you may not have perfect pass-through. So you need a pass-through measure, which is just the ratio of the input price index to the output price index. So if the input price index is higher than the output price index, your costs are going to grow over time in a real way. Same with your wages. If your wage price index is greater than your output price index, it's going to grow over time. This term here and the growth rate in your costs will model margin compression. So you'll get real revenues across the top, and then you'll model your margin compression. It could be that you say, look, our input cost price index will actually trail our output price index, which means that on a real basis your costs would decrease, so you'd have margin expansion as opposed to margin compression. But you do have to model the relationship between the input price index and the output price index. Once you do all of that, you will end up with a series of real cash flows. Real cash flows should be discounted with a real interest rate, which means you remove the inflation component. You assume a real return plus a real risk premium as well. So we need a real rate, and then we'll add our risk premiums, our real risk premiums onto that. Well, it doesn't take much to see if you have a higher real rate, you will end up with a higher discount rate overall. But it doesn't end there. You have your risk premium as well. The higher the real risk rate goes, the higher the risk premium goes as well, which means it's a double hit to the discount rate. So let me see if I can explain that to you. Let's say that you observe the 10-year real rate. Let's say it's 50 basis points. And in that environment, the economy has certain desirable features to it still. So that you might say, given the level of economic activity, the level of real GDP growth, and given the risk attributes of this particular company, we want a 600 basis point risk premium on top of the 10-year, and that would be a discount rate on the equity. Let's say, well, if real rates went to 100 basis points, that actually would put downward pressure on real GDP. If that puts downward pressure on real GDP, it also puts downward pressure on these cash flows, makes them riskier. And if they're going to be riskier, I don't want 600 basis points. I now need 700. So as the real interest rate is going up, the real risk premium is going up by the same amount. So you're just going to get a higher discount rate overall. That's why increases in real rates are so crushing, because they hurt the present value of all projects. Well, if you have that situation going on, you're going to have a significant drop in investment. Well, investment is what we do today for tomorrow's future growth. So if you hollow out investment today, where are you going to get tomorrow's future growth from? And we're seeing this in the housing sector in the US. There was underinvestment there for a long period of time. So now we have chronic shortages of housing, which pushes pricing up dramatically. If you look at the energy sector, you've had underinvestment there for so very long. Well, where are you going to get growth in output? There is no growth in output in the oil sector right now, because you haven't had any investment previous that would result in new output today. That's the danger for the economy, is that you hollow out investment, and investment is future growth. And if you hit future growth, you have lower cash flows, and if you have lower cash flows, you're going to have lower valuations. Before we take off from here, let's look at our break-even rates. The 5, the 7, the 10 break-even rates got a little bit higher, but the 10, I don't know that I'm going to read too much into that. And then they decreased from the 20 and the 30 and the 5-year forward, which is what happens between the 5 and the 10 on a forward basis, also decreased as well. I'm not finding a lot of information in here. Those are not significant moves in one direction or another. You have increases on the front end, decreases on the back end, implying that, well, inflation expectations are probably going to be heightened for a little bit longer, but the reaction function of the Fed, which is just to raise interest rates, is going to take care of it in the longer term. Let's look at CPI. We'll look at a couple of categories in a bit more detail, and we'll ask a few interesting questions about them. This is pretty much what made Friday what Friday was. It was just a negative out of the gates. As soon as it hit, the market decided that, no, we're going down. Headline CPI 8.6%. The previous month headline was 8.3%. If you strip out energy and food, you get to core inflation. Core inflation was 6%. The previous month it was 6.2%. So core inflation actually came down on an annualized basis by 20 basis points, even though headline was up. Headline is got food and energy in it. The reason food and energy are stripped out to get to core is because it is believed that the interest rate really can only affect core inflation. Higher interest rates aren't going to change crop yields or the availability of food or the price of food at all. It has its own drivers of price, and interest rates really are not the thing. Same with energy prices, because it's such a volatile component that it goes up, it goes down. It's stripped out because it is believed that higher interest rates aren't really going to change the price of gasoline or the price of energy. So that's why they're taken out. Janet Yellen made a statement that when I heard it, I thought, that doesn't seem to make a lot of sense. Half of U.S. inflation is a result of new and used cars due to the chip shortage. We're going to find out if that's true or not. When I first heard that, I go, it doesn't seem right, because the weights would have to be very high on new and used cars, and the weights are low. So it cannot possibly make up half of the inflation, but we'll check it out. Look at some of these categories here. Food, 10.1% here. Food at home, up 11.9%. Interest rate isn't going to do anything about that. Energy, thinking of the whole category, up 34.6%. Interest rate can't do anything about that. Energy commodities, 50.3, broken down into gasoline and fuel oil, 48.7, 106.7. Energy services, 16.2. That's broken into electricity and nat gas, 12%, 30.2%. Anybody who's watching nat gas knows that it is just on a tear. And this is the summer. Now wait till you get into the winter. Wait till Europe gets into the winter and it needs nat gas. Oof. New vehicles, 12.6%. Used vehicles, 16.1%. Apparel, 5%. Now that seems odd. ODD odd. Because when we looked at the PCE, we saw negative numbers. Walmart, Target, Abercrombie and Fitch, a whole bunch of other retailers, clothing retailers, saying, hey, listen, we're overstocked. We're cutting prices. That seemed to be a common theme, that we're cutting prices. How is it possible that it's measuring a price increase? Shouldn't it be a price decrease? So if we look at May, 0.7, how come it is going up? Shouldn't it be going down? And I'll explain why the CPI isn't the best measure to capture things like that. Let's distinguish, and I've done this before, we've distinguished between the difference between the CPI and the PCE. The CPI is a price index. So there's a bundle of goods with a fixed weight, and it prices out that bundle of goods from month to month, and it measures what the prices are for the next buyer coming in. Because when we look at shelter down here, It is broken up into rent that people pay, which we can measure, and it has another category called owner's equivalent rent. This is because housing doesn't find its way in. We don't measure the price of houses in CPI. We measure the service, the price of the service that the house provides. So it's an equivalent rent. It's rent that the owner would pay themselves. So it goes along the lines of, if you had to rent your house out, what would you rent it for? And then from there, it calculates a price difference every month. But there are people who completely own their homes, to people who just took on a mortgage right now with the minimum amount of equity. And then it runs the gamut. It's not like everybody has a mortgage. Lots of people completely own their home, free and clear. So that's not in, they don't experience that cost. Now the thinking is, but they could experience that cost if they rented out their house. That is what they're giving up. Hence, that is what it's costing them. That is the thinking behind that. But it's to get to a price index, not a cost of living. When you own your own home, your cost of living is not measured by the CPI. It is a price index, and it's prices for the next buyer, not buyers that bought 20 years ago or 10 years ago or 5 years ago. They don't have that level of inflation. This is for the next buyer. The PCE, on the other hand, is a cost of living index. It measures your cost of living. To distinguish between the two and how the two could be measuring the same thing differently, let's imagine a pair of pants in April was $90. And in May, you price out that pair of pants and you find out that it's $100. However, everyone is overstocked on this $100 pair of jeans, so there's a 50% markdown and it's selling at 50% off. CPI says, that doesn't matter. This is what matters. What is the price of it today? 11.1% higher. PCE would say, no, we measure what you bought, what you paid for. So it's $50 versus $90 last month. It would show a 44.4% decrease. So the PCE measures the cost of living because it only cost me $50. It didn't cost me $100, whereas the CPI measures the price level without considering that something could be discounted. So buy two, get one free. Great for PCE. Not going to be captured by the CPI. The other issue with CPI is this. Let's say you have this at 90 and you go to 100 and none of them sell. None of them sell at all. Well, the CPI would still show the price level has gone up because in an absolute sense, the price level is higher. It doesn't matter if people bought it or not. The price level is higher. The fact that no one bought it is support for the law of demand, which means at higher prices, demand will drop. So it doesn't matter if nobody bought it. If nobody experienced that level of inflation, it does not matter. It still was an inflated price. Whereas the PCE would say nobody bought it, it has a weight of 0%. And it would not be counted because if you didn't buy it, that is not a price you experienced. Hence, it cannot possibly be part of your cost of living. So the CPI can be misleading because of that. So apparel, 5%. Maybe the sticker price was up 5%, but you have inventory clearance sales going on all over the place. So can we look at CPI and say, aha, that will destroy demand? Or should we look at PCE as a gauge of demand? Because retail sales are okay. Growth in consumer credit is okay. It's not falling off a cliff. All of these things that point to the health of the consumer seem to be okay, because we don't really do much with CPI. CPI is there as a broad measure of price pressure across an economy, but it doesn't explain why that price pressure is there, nor who experiences that price pressure. The PCE does a lot better job at it. Let's go into some of these categories a little bit more. And if you are wondering, the Fed uses the PCE, not the CPI. And the PCE has been promising for the last few reads. CPI will be considered, but I think they'll look at this and they'll say, you know what, it is going in the right direction. Yeah, headline isn't going in the right direction, but energy policy is not something we can do anything about. Food security is not something we can do anything about. In fact, we can only make it worse. So I think they'll probably be more pulled towards this in the CPI and more pulled towards the PCE and the anecdotal evidence out there from the retailer saying we're completely overstocked and we're marking down inventory. So I seem to think 50 basis points is probably the game in town. I don't know that they're going to deviate from that, but again, you know, you got to put something, some weight on the 75 because you just never know, because it could be part of the conversation. You could have some alarmists. You could say, look, if we're going to raise rates another 100 basis points, why not do it now? Why not just do it now? You know, you could get that. So 50 is my base case by about 90% with a possibility of 75. Okay, I have 4 categories on the screen: autos and housing, which are part of core inflation, and I have energy and food, which is part of headline. So we'll look at those. These are the weightings in the CPI basket for each of these. So autos new has a weighting of 4.031%, used 3.992%, etc., all the way down. If you add up these 3 categories, you get to 47.336, and if you put food in, you get to 60% of the items being measured by CPI is caught by these 4 categories. 60, almost 61%. So it's a nice sampling to use. I use these because the interest rate isn't going to do much to energy or food. It's going to do nothing to food, by the way. It has no effect on food. Food is driven by its own drivers. The amount of land available for planting, the weather conditions available, the harvest yields, the amount of fertilizer being used, the yield per acre. It has its own drivers that interest rates aren't going to do anything other than hurt farmers. It hurts farmers' margins, but it's not going to do a single thing to change the state of food prices. So it knows that. They are well aware of that. That's why they look at core. Energy is another one that you're not going to do too much to affect. It has its own drivers as well. The belief is, well, we can affect housing and we can affect autos, and typically in a market or an unconstrained market, that is true. Once you introduce constraints into a market, your optimal output can only be lower. And that's the same with any kind of optimization program that you're working with. Whatever you're optimizing, the moment you introduce a constraint into an optimization, you can only do as good as or worse than the unconstrained optimization. So we have to ask, are autos and housing, is the output of autos and housing constrained in any way? And if they are, then the interest rate is going to have less and less and less of an effect. And I have all of the reasons why I think it's going to have less of an effect. What are these numbers over here? This is, I took the weight on autos, let's say new autos. Then I calculated the price change on the index month over month to get the percentage change, multiplied it by the weight to get the contribution to CPI. And these are in percents, 0.0391%, 0.0267%. So there's autos, there's housing, there's energy, there's food. If you add that all up, you get to 0.4454%, and headline was 1%. So these 4 categories make up 44.5% of that 1%. If we strip out energy and food and we just count 1 and 2, this is autos and housing, it is 0.2521% of 0.6%. Roughly 42.5% of core inflation is housing and autos. 42.5%. You're not going to get to 2% unless you affect auto and housing. Simple as that. You're not going to get there because we know you're not going to affect food, you're not going to affect energy, and I'm going to make the case here that those prices are here for a long time. So let's look at autos and housing. because that's what you're going to have to work on. 42.5% of the 0.6, which means if everything else were a zero, everything else were a zero, in other words, no inflation month over month, every other category was a zero except autos and housing. And with autos, I'm just saying new and used. I'm not even talking about automobile services, just new and used. And the housing rent and owner's equivalent rent, if everything else were zero, inflation would have came in at 0.25 month over month, 0.25. So annualized, on a simple annualization, multiplying it by 12, you'd get to 3%. So if you're going to get to 2%, you must either cause significant deflation in every other category, or you have to affect autos and housing, which means you have to hammer these down hard because we have constrained markets. And whenever you have constrained markets, your relationship, A leads to B, works well when there are no constraints between A and B. But when there are, A doesn't always lead to B. You need much, much more A to lead to B. Significantly higher interest rates than you normally would, because you have to first destroy the demand in the lineup to get into the store before you actually destroy demand in the store. There is a constraint. You got a chip shortage. The CEO of Intel says don't expect that to abate till about 2024. That's going to be with us 2024. It's 24 months from now if you want to get to June 2024. 24 months. I tend to believe him. Oh, yeah, he might be talking his book. He might be talking up his share price. But, you know, if it's going to be 2024, this is not news I haven't heard anywhere else. And if it was improving, I would hear something about it. Or the auto companies would be saying something about it, or production of automobiles would be higher, because that is the big constraining factor right now pushing automobiles out the door. Well, when you look at May's seasonally adjusted annual rate, no, it's not improving. So we'll look at that shortly. Chip shortage, metal pricing, way up. Rare earths, way up. Anything to do with batteries, lithium, nickel, cobalt, way up. Lithium, for example, is up 392% year over year. It is a super tight market. How do I know that? Because lithium prices are up 392% year over year. If it was a well-supplied market, prices wouldn't be up. You want to find tight markets? Find prices that are up significantly year over year. You're going to find markets, if you look at the futures curve, that are in significant backwardation. There's your spot price up there. Those are tight markets. Well, we have this major push towards battery electric. Governments saying, well, now it's got to happen. You know, European Union by 2035. The council actually voted on it. It is now law. 2035, let's outlaw internal combustion engines, sales of new internal combustion engines altogether. I believe there was a small carve out for plug-in hybrids and hybrids, that it'll be longer than 2035, but they're on the chopping block. Well, that's not going to reduce the demand over here. In fact, you could even crush auto demand. But because of these targets that have to be met and the surge into EV, this is only going to get worse. You're not going to fix auto inflation, because it's everybody has to pay for this. All tight markets, it's going to stay elevated for now, and it's actually going to get worse because they are going to hit a wall in 2025. Late 2024 into 2025, you're going to hit a wall, because the demand for the materials are going to grow at that point, are going to grow faster than the supplies can grow. It's just the reality of things. If you want to know more about that, you can look at the video I put out on the ice age is far from over. And I have another video coming out this week as an answer to some of the objections based on my projections for Tesla. All good objections, by the way. When I read them, I go, that's a good point, and that's a good point, and that's a good point. But I do have evidence, I think, that can support my position. I will expand on this a lot more and why I think that's the case. And not only why I think that's the case, but we're going to refer to a company that is in the market of negotiating contracts and tracking spot prices and clearing the market in these metals, and we're going to see what it has to say. You're not going to affect this unless you get demand down, and you have to get demand down not right now it's at 12.7. In 2015, 16, 17, it was 17.5 million. And you would think, well, if you can get 17.5 million down to 12.7, you've crushed demand. Yeah, but you're not starting at 17.7. You're starting at 12.7. There is demand for 17 million cars, but there's only enough supply to satisfy 12.7. So you have to get rid of everybody in line first, then start working on destroying demand. You got to get auto sales in the US down to probably 9 million or 8 million on a run rate before you actually can cut production enough that it would start to reduce these prices out there. However, you have Europe, you have China, you have every country in the world that are rushing in. So you would have to have this global crushing of demand, not just crushing it in the US, crushing it globally. That's not going to work. Take this off the table. Housing. We know we have low supply. There are material shortages, and you have labor shortages. We know this. So, being that supply is so low, is it possible to affect this? Housing, probably more so, because housing isn't a global market. Housing is a local market to the US. You can crush demand in the housing market in the US, which is probably what they're going to focus on because it's got a big chunk here, 0.1863. So if you crush demand everywhere else where it equal, well, not everywhere else, if you crush demand here and get this to equal 0 month over month, your headline goes from 0.6 to 0.42. That might be something livable. And if you can get some of these other categories to come down even 20, 30 basis points from where they are, maybe. We'll look at housing and we'll see if we see any indication that this is happening given how low the mortgage market index is already. How much lower can it go? And prices are still going up. So we'll put a little pin in this one right now and say, let's just visit this in a second. Here's where things get really ugly. Energy, not going to happen. Energy's going higher. Energy is only going higher, and wait till you hit the winter. If you think electricity and natural gas prices are high now, wait till you hit the winter. Years of underinvestment in both energy and production and in pipelines. Years of underproduction. Tight market, and this tight market is not going to change. EV adoption. Why invest in any project? 4 to 8 years to cash flow on any new field, and you need a 20-year life. And to make matters even worse, just to push the oil executives into non-investment even further, the G7 last week said they are going to end public funding for fossil fuel projects. No more subsidies at all, which just raises the cost to explore. You have, for 10 years, been telling oil company executives that they are evil, that they are part of the problem. You have threatened to slit their corporate throats open, that you are going to kill them, that you are going to make the terminal value of all of their businesses equal to 0. You're going to obsolete them and drive them out of town. Do you really think they're going to spend, any board, any responsible board out there is going to authorize any investment in any new exploration that's going to take 4 to 8 years just to get to cash flow? And you need 20 years to break even? No. Now, what makes this a little bit worse is reports of water coming up in wells. So Saudi Arabia is a good example, and they've admitted this on their own. The largest oil field they have is super long. It's like kilometers long. And they have wells in the center of it. And they drill in wells on the sides of it, way down at the edges of the oil field here. And this is what they used for the longest time, are all of these wells in the middle of the field, and the oil came gushing out. because of the pressure under there. And then pretty soon it wasn't gushing out anymore. So that's why they built these wells around here, and they pump water in to raise the pressure, and oil comes gushing out. All oil. Well, sometimes you get water coming out because the water, once you push the oil up as much as you can, once you put as much pressure as you in, all that water you pump in's got to come out at some point. So about 15 years ago, they noticed that some water was coming out, but not a lot. Now they've got some wells where nothing but water is coming out. The IEA has predicted that over the next, I think it was the next year, the next 2 years, that the production decline in oil is going to be about 6.77% a year, which means you're going to need to bring 2 new Irans on every year. Underinvestment and waning production. This is only going higher. Food. What are we going to do here? Lack of fertilizer. The best fertilizer is potassium nitrate, also called potash. While Russia had big reserves of it and was a big producer of it, that's done. Canada produces this, but when you take a certain amount of supply off the market, it's gone. That's the best fertilizer. You can make fertilizer, but you have to use natural gas to make it. Well, we just talked about the price here, so that means you're going to have, any existing sources are going to have super high prices. You need fertilizer to get the yields. You don't have that fertilizer. The less fertilizer you use, the lower your yields are going to be. The lower your yields are going to be, the higher food prices are going to go. You also have lower acreage. Some parts of Ukraine are gone. There are some parts, some farming sites in just the U.S. alone that experience drought over a number of years, that they're simply not viable land any longer. So you do have lower acreage. And combine that with the weather, you have volatile growing conditions in a lot of regions. Regions that used to be great for a certain crop are, they're okay if the weather does this and if the weather does that, and we get a lot of rain in the beginning of the season and none at the end. But if we get, if it changes depending on what we're planting, we're kind of screwed on that one. Combine all that together, a lack of fertilizer, the high cost of existing fertilizer, lower acreage, volatile growing conditions, and this bad situation is only going to be made worse. Not going to do anything with this, it's going higher. Not going to do anything with this, it's going higher. You might be able to do something with this by crushing demand, and you might do something here, but you really, really have to crush demand, and I mean crush it. Therein lies the problem, is if the central bank has its mind set on fixing inflation, this is global. This is global because it's constrained market. This you can have an effect on. This, forget it. This, forget it. So don't even pay attention to headline inflation. Headline inflation is going to continue to be resilient. It is everything else you have to destroy. If you can't destroy autos, you must really destroy housing and get deflation there to offset inflation in autos. You must get deflation in a whole bunch of categories to offset inflation in autos and to offset the headline inflation in energy and food. That's what scares me going forward. So let's, on the next screen, we'll look at our probability of a recession. So here I have recession risk at 70%. Which seems rather high, but it's because I'm looking at it under 2 conditions, a policy mistake pathway and an inflation's expectation pathway. The policy mistake is using the interest rate until inflation is 2%, period. You have to destroy demand in so many parts of the economy, and not just the U.S. economy, but the global economy to get that. But all central banks seem to be raising rates. You get into a global recession, that nobody escapes that. That is a policy mistake pathway, because a lot of the inflation that we can see right now is because of fiscal policy sort of short-sightedness. The idea that you can go from one technology, to another technology in one leap. There is the history, if you like history of economics, there is one economist called Schumpeter who came up with the term creative destruction. And if you want to read more about this one, great book called Profits of Innovation. It's spelled Prophets, not profit as in financial profit, but Profits of Innovation, which is kind of a play on the word profit as well. And he wrote way before the solo model of the 50s, way back when the output function, or output was a function of land, labor, and capital. And what he said is, well, you can't ignore innovation. Innovation comes in waves, and sometimes an innovation is so radical it will just completely destroy the industry in which it was founded, in which it was meant to survive or to grow. And in doing that, you may actually force the economy into a contraction in order to get higher growth. So he was saying, if you just think of land, labor, and capital, these are finite. In other words, all economies are destined to grow and then stagnate. But we haven't seen that. So he talked about innovation, meaning that you have growth and then you have an innovation come along that's so radical, it does this to the economy first before the economy then goes on to a higher level of output than it would have achieved on the existing technological curve. This was formalized later in the 1950s with the solo model, where output is a function of some kind of technological factor along with labor and capital being land as well, so that the technological factor was introduced into it. But Schumpeter was the first one to talk about this. Well, this is what we have with battery electric vehicles, is you have a significant change in technology. And you're trying to go from one technology to another technology in one jump. That is going to be extremely disruptive, and that is the destruction part of it. You're destroying this old industry to build a new industry upon it. And that's causing a lot of dislocations. And you have a lot of policy, government policy, saying, yeah, let's lean into this. Let's lean into this. Boo, boo, you guys. Boo, you guys suck. You guys suck. We're going to hang you if we see you in public. Instead of thinking, well, hang on. Why don't we transition to this so that we don't cause all of these market disruptions and market dislocations? Why don't we transition to it over time? But the thinking is, well, no, we got to work fast. You got to get it done really fast. Well, you're going to get this. You are actually going to get this kind of thing happening before you can go on to something higher. You're going to have to destroy first. Well, this part of inflation being caused right now is all policy induced. So let's go back to this here just to get that out of the way. Policy mistake pathway, because this is policy induced, it's going to be interest rate resilient and interest rate insensitive. So if you continue to raise the interest rate in hopes of doing something there, that is a mistake. You can't fix it this way. It's not a nail. So the interest rate is a hammer, and this is not a nail. You can only do damage. So I put the probability of a recession, if we follow a policy mistake pathway, at 100%, because there is no way to get inflation down to 2% without completely destroying the economy. You have to force a recession to get it down. There is no other way. If you look back through history, and a number of other places have cited this information as well, every time inflation is greater than 4%, you cannot get it back to 2% without a recession. It has never, ever happened. So if they are set on 2%, if they keep affirming that we're going to get it to 2%, we're not going to stop till it gets to 2%, you can put a recession at 100%. If they are going to work on just inflation expectations, in other words, they're going to raise rates at a measured pace to work on your expectation of inflation. You can actually get inflation down if you work on the expectation of it, because if I expect prices to be lower in the future, I won't be raising my prices now by that much in advance of it. And when employees come to me for raises, I'll say, look, you think it's going to be that, but prices are going to be lower in the future. Inflation is going to abate, so the wage pressure will start to abate. And because of that, that will create the very disinflation that we need. If I don't think there's going to be inflation, I won't raise my prices, thereby creating the very inflation that I thought would happen. So if you can really hammer down inflation expectations and not necessarily use the interest rate to hammer down inflation, if you can work on the expectation, you can avoid this mistake. I put the probability at 40%. Reason I do that is endogenously induced recessions are about 15%. That's any year, in any given year, there's an empirically observable probability based on history of a recession, about 15%. But once every 7 years is what 15% is saying. Is about, they come with not always the same, but on average is about every 7 years, so 15%. But we have an interest rate accelerant going on right now. So I just bump it up subjectively by another 25. You can change it to whatever you want. So 50-50, whichever way we go. Given these probabilities and these weightings, you get to 70% probability of a recession. However, if I see this happening, a 75 basis point hike, or on Wednesday they project, instead of 2 more increases of 50 and then moderating to 25, if they start projecting out 3 or more increases of 50 basis points, it's more likely they're going to be on the policy mistake pathway. I would then raise this probability from 50 to 90%, which makes the probability of recession almost a sure thing, 94% on that one. If on Wednesday it appears that they're going that way, we gotta look at S&P earnings. Lower S&P, the EPS by 10 to 15% this year. Within a full recession, it's usually about a 30 to 35% hit to EPS. So a 10 to 15% pullback, and the multiple can drop to as low as 14 or 15 on a forward basis. What range would we have on the S&P if that happened? Let's take the lower end of the drop with the higher multiple, 3180. And if you say, well, they drop by 15% and it's only a 14 multiple, you get to 2803. I have seen forecasts for 3200, 3400, 3600, 3800. I've seen all of those. I don't know if I've seen a 2800 yet. But if we move this way and decide to use the interest rate hammer, and that everything is a nail, autos are a nail, housing is a nail, services are a nail. If everything is a nail and this is all you have, then yeah, that is the bear case here. And I've said it before that it's hard to make the endogenous bear case, but exogenously. Exogenous means that you're inducing a recession from outside the system, not from within the system itself. The policy mistake is a surefire way to get there. All right, let's look at autos and housing just a little bit deeper. May sales in the U.S., SAAR, when you see that term, it means seasonally adjusted annual rate. 12.7 million. That does not mean 12.7 million vehicles were sold in the US in the month of May. It means if you take the vehicle sales during the month of May, adjust them for any seasonal effects, and annualize it, we would expect over the year that it equals 12.7 million units. That is down 12.6% month over month, down 30% year over year, and down 20% year to date. But if you go on to a lot to buy a new vehicle or a used vehicle, slim pickings if there are any, and if you want a particular type of vehicle, sometimes you're in line for 6 months, 12 months, sometimes up to 2 years you're in line. So this does not sound like you're running at 12.7 million because the demand is just not there. The demand is there. If it wasn't there, then new cars and used cars would not be contributing to inflation. So right away, I know that the demand is there. Then why is it so low? 14, 15, 16, 17, you're anywhere from 17 million to 17.5 million. You're some 30% lower from those levels at this point in time. There's chip shortage. A lot of factories are running below the potential capacity that they have, simply because if you can't get anything in the door, you can't get anything out of the door. Car companies are also reporting record low inventories of vehicles. Same with dealerships. They've never made more money per car. They wish they had more. I don't know if they wish they had more cars, actually. The reason they're making such big margins per car is because they don't have any cars to sell, or they have very few cars. If there were no constraints, if this was an unconstrained market, the dealerships wouldn't be making that much. But record low inventories. And a telling sign is there have been no profit warnings for Q2 by any OEM yet, which means demand is not being destroyed. Now, there's a difference between demand and demand that can be satisfied. So I've said this before. Let's say this is the club you want to get into, and it's full, and you have a lineup to get into the club. If you destroy demand, some people here may leave. You raise the prices inside and you raise the cover charge. Some people in here may leave. Other people will pay the cover to get in, and some people may leave the line. You've got to destroy the whole lineup first before you can begin to act on the customers inside the establishment. It's the same with the auto companies. You have to destroy the waiting list first. You have to destroy that lineup. Now, if a company says, listen, we are now sold out for the next year, and there are some companies now that are no longer taking orders for certain vehicles because they simply, there's just no point. Well, all of those vehicles have been ordered. So even if you do raise rates right now, that's not going to do anything to drop the demand for the raw materials all the way to the end of the year, because that's already been done. So you're not going to see those inflationary pressures abate till sometime next year. But you're raising interest rates now based on the data you have now. I ordered for myself, for my house, I ordered a hot tub and an infrared sauna. Hot tub is going to be August, September. That's it. Well, who wants a hot tub in July in southern Ontario with the humidity we have anyway? So that's a good time. The infrared sauna, December, January. And you got to pay your deposit for that. Deposit paid. Which means there it is. So even if you destroy demand, you're destroying demand for after December and January delivery. You're destroying demand that will come after August and September delivery. Because if you raise interest rates and I go, ouch, that hurts, I'm going to go ahead and cancel my orders. Well, I've already paid my deposit. I've already got money segregated for that. You're not going to affect anybody in the lineup that's already waiting for their supply. So you would really have to do a lot of damage here. And I'm afraid that that's what they're going to do. Housing, little bit better, but still a challenge. Mortgage applications down 6.5%. For the week ending June 3rd. Refinance index of that 6.5, refinancing is down 5.6 for the week. Purchase index down 7.1 for the week. The mortgage market index, which is the market for all mortgages, is the lowest it's been in 22 years. This week we get some more data. On the 15th, we get mortgage applications and the National Association of Home Builders Housing Market Index. On the 16th, building permits and housing starts. And if we're going to see some price pressure relieved in the housing market, you need these to be up and you need this to be up, with this down again. Realtor.com, active listings up 13%. This is for the week ending June 4th, and this is year over year. Active listings are up 13% over last year. And this is another promising thing. They're selling 5 days faster. Last week they were selling 6 days faster year over year. So they slowed down. So the turnover is slowing down a bit. The listings are increasing a bit. New listings up 2%. But look at this. You still have year over year almost 17% in price increase. To put it in perspective, let's look at it over a 3-week period. Year to date, week ending May 21st, May 28th, June 4th. Year-to-date, median listing prices is up 14%. Would you say that this is a CPI-based measure, or is this a PCE-based measure, the median listing price? That is not the price that people pay. That's the price that it's listed at. That is a CPI-based measure. So this right here measures the price increase on the listing price, but it does not account for what it actually sold for. And we are seeing, or at least we saw last week, that the percentage of price drops on the listing prices is increasing. So it is increasing, the price drops are increasing, but we're assuming that when a price has been dropped, it shows up in the listing price. But what if an offer was accepted below the listing price? This would not capture it. So that's a big difference between something that just measures the price at which something is being sold at versus measuring the price at which something was purchased at. May 21st, 16.6% year over year, jumped to 18.2% year over year. It's come back down a bit to 16.9, probably because of the increase in active listings, but still higher than it was for just 14 days prior. For new listings, it's down 1% year to date, year over year. For the week ending May 21st, it was up 6%. Now it's only, and then the next week was only up 2, still only up 2. So that doesn't sound like the market is improving. It looks like it's improving here. Year to date, we're still down 13% year over year. But week ending May 21st, active listings were up 9% year over year. Next week, they were now up 11% year over year. Now they're up 13% year over year. And if that sounds great, keep in mind that last year is a really, really low base. That even though you're up 13% year over year, you're down some 50% on active listings pre-pandemic. This is also promising as well. Week ending May 21st, May 28th, houses were selling 6 days faster year over year. Now it's only 5 days faster. Still faster than last year. Housing is still being cleared out faster, even though prices are 17% higher. But, you know, we got to look at the change, right? It's taken a day longer. 1 week goes by. You have 13% increase year over year as opposed to 11%. It's taking 1 day longer. It appears to be moving in the right direction, even though it's just one little step in a very long journey that you have to go to get this down to 0, or at least something more well-behaved like 2%. From 16.9 down to 2%, you've got to get, instead of 5 days faster, you've got to be about 15 days slower. Instead of 13%, you got to get this up 100%. Instead of the new listings 2%, you got to try to get this to 40-50%. You have to increase supply dramatically, reduce the demand, and you will notice it with this. You'll see that this is not faster than last year, but slower than last year. These are, you can then get this down to somewhere around 2%, which would be in line with the Fed's target. That's a lot of heavy lifting to do, considering the mortgage rate is already sitting at 5.85%. 5.85%. We were, I think, 5.44 last week, and these numbers were reflecting about 5.3 to 5.5 on the 30-year mortgage. 5.85. We'll see next week what week ending June 11th will have. Okay, here's the SPY. Look at these last 2 days. There's Thursday, there's Friday. These are daily bars on the SPY. Here was our peak for the year back, I think it was near the end of December, beginning of January. I think it was January 2nd, 3rd. Our 3rd or 4th that we hit a peak, and then we've gone down from there. From the peak to where we are now, we're down almost 19%. We're still not in bear market territory. A couple of weeks ago, when we were down here, I gave you a strategy of buying a call and then letting the price movement determine what you would do next. Because the S&P has skew, if we buy a call and the market drops, we could go really far back or really deep in the price here and sell a put to finance that call to be cost neutral. And if the market pulled back first, it just means we could get that put further and further out of the money. And if the market rallied, I recommended the 40.50 on the index as a first line of resistance, and 41.50. That what you could do is you could sell a call at 40.50 or 41.50 and enter a bull spread. And the market seemed to find resistance right around 41.60. And down here, we can see that it was supported in this channel at about 40.60. These two numbers are going to be important for the strategy I'm going to show you. There is more discussion about shorting the market at these levels. I hear more people saying that that they're shorting the market or would short the market at these levels. When we were over here, the conversation was, I'm certainly not going to short the market at these levels. I will wait until the next rally and then I'll build my short position. But given the reaction we had on Friday and given what we think the Fed might do, the real possibility that we're going to enter not only into a U.S. policy mistake, but a global policy mistake among all central banks thinking they could fix constrained markets with the interest rate. You have to really push that interest rate to get it done. Probability of global recession would be almost 100%. So the thing is, I will definitely short the market at these levels, which is not always the best strategy. I'm going to show you a better way to short the market if you really do want to short the market. And that involves selling calls in the money calls. So September 372. I picked 372 because the combination of the strike price plus the premium gets me as close to 40 or 406 as possible. And it gives you a break even of 404, which is just sitting right under this first line here, which, because it was support in this channel, will be resistance on the next rally. Margin's going to be 11,760 to get that done, which is a big chunk of money. You can cut that down a lot by buying a throwaway option. Now, that's an option that you buy that you have no belief that it'll ever pay off. You're simply just buying it to throw it away. So you can go and buy a 444 call and pay $2. That will lower your break even to 402. Why would I do that? It gets my margin from 11,760 down to 7,200. It requires less capital to have done. By giving up $2, I drop my margin requirement by $4,600 per contract. So if you're doing 10 contracts, it drops your margin requirement by 45 grand right away. Well, that's significant when you're calculating your ROI. Or if you have a constrained portfolio, you got 20K, you can only do one of these. You can do two of these. The other option, if you're comfortable with a long position at a lower price than 39, if you were going to short the market at 39 or 390, which is 3,900 on the index itself, you got to have some number at which you're going to cover, whether that be 3,700, 3,600. So it's the same as covering at 3,720, 180 points down, covering at 3,720. If you want to set up what I think is kind of a, it's riskier, but I think a better rewarding trade for me, would be sell the 372 call and the 372 put at the same time. It gives you 1390. And this is chosen for a very particular reason. Your break even on the upside is 417.90 or 418, which is up here. And on any rally, since you didn't breach it the last time, given what we know now, I doubt you're going to breach that again. So I don't think that I'm going to be crushed on a short rally. However, my downside, my break even on the downside, and this is not 368.10, it's 358.10. My break even on the downside is 358. Where is this? This is 380. This would be a 370 down here, 360 down here. This would have to drop all the way to here on a sell-off down to 358.10. If I'm comfortable being long the market at 358.10, let's say it busts through that and goes to 340, and I'm comfortable at 358.10, then for me, I have no downside risk. Because chances are I probably would have bought around 3,600 anyways. I would have said, well, this looks good enough, and my horizon is the next 5 to 10 years. I'm good here. Here's my first position in the SPY, and then maybe I'd play it a little bit lower and add a little bit more to the SPY, and I keep playing it that way. But that, I would see that as less risky, because at lower prices, I'm more and more willing to own the index. So a way to think about short positions versus what most people do on rallies, they tend to sell positions. I'll lighten up on the way up, and then I'll add it on the way down. I'll lighten up on the way up and add it on the way down. Well, that works well if we're going to trade in a channel, and you can find predefined levels to do it at. But when you lighten up on the way down, you lighten up on the way up and you add on the way down, if it continues to go down, you're going to suffer even more. So I don't really do too much of that. I sell in the money calls, and I choose the delta on the in the money call to be about 2/3 the underlying, which is a 1 standard deviation move. So if you're doing it 1 month out or 2 months out, a 1 standard deviation move covers gives you about a 60% 68%, almost a 70% probability of being correct. Considering an underlying has a delta of 1, it means you're looking for options which have a delta of 0.666 or higher. And if you can just ignore the symbolism of that number for now. What does that look like? Well, let's say that you have a stock that starts to rally, and you think, you know what, I'm going to sell some of my position at this point. Well, you can find a strike price with 0.66, and that strike price may be down here. Well, what you're going to get is you're going to get the intrinsic value, plus you're going to get some time value component, which means your break even will be somewhere above where the stock price is. So if the stock price, once you have this in place, the stock price decides to retreat to here, you don't lose a single penny. Your gain is locked in because you sold that distribution to someone else, which means you're not going to suffer that. Once it drops down below that, then you will start to lose again. But the combination of the time frame plus 1 standard deviation, if you can forecast out a bit, I find that to be more profitable and more effective than buying and selling. Buying and selling is just to work it that way. So how I combine the SPY with individual positions is like this. On individual positions, if I want to lighten up, I sell an at the money call and I combine it with an in the money market ETF. So to use an example here, let's say a stock rallies up and I say, you know what, let me lighten up here. Let me sell 1/5 of my position. Instead of doing that, I will sell at the money calls on the position. Then I'll find the index, and I'll find a delta on the index that has 0.66 or higher, and I will sell a call on the index. Now, if the market pulls back, I will start to lose money because I don't have this intrinsic value cushion anymore. This has no intrinsic value. It's all just time value because it's at the money. So I'm going to lose on my position faster than I'm going to gain on my option, but because I sold an in the money call on the index, typically what makes this turn around is the index dropping at the same time. So if the index drops, your positions tend to drop. I will make positive return on these options over here, positive return here while I lose on this position. And I try to set these up such that I am dollar delta beta neutral as possible. So I lock in my gains on every rally, and when the market drops down, my portfolio value rarely changes. I take off all those hedges, and then I think about how I want to start playing the downside of that. So as the market does this, your portfolio value does this. You lock in every gain. You ride the gains. You lock it in as the market is selling off. You're not doing anything. You might drift down a little bit, but you ratchet up slowly, as opposed to saying, I'm going short the market or I'm going long the market. You have a combination of long underlying positions hedged out with the deltas, using the index as your hedging tool, your in the money options as your hedging tool, which give you some margin on the upside. Just a way to think about shorting the market rather than shorting the underlying itself, try selling an in-the-money call. And, if you really want to do that. And on any rallies, as opposed to selling 20% of your position, think about selling an in-the-money call on 20% of your position. Especially if you're going to sell dividend-paying stocks, you may as well hold on to your dividend-paying stocks, get that stream of income, but also sell some of the distribution, including some of the distribution that's already in the money, which means any retreat, you're winning. Anyways, we'll leave it here for the week. That's all I have. The only game in town right now is the Fed on Wednesday. Nothing else matters. I don't know that we can read too much into Monday or Tuesday, any price action at all. The narrative will control the price action, whatever that narrative happens to be. And then we'll see what happens on Wednesday. And if on Wednesday they come out with 50, and in the press conference he talks about 75 not being necessary, and can talk a good story while still managing inflation expectations, I think we could have a rally. But if he moves 75, or if he talks multiple more increases of 50, or puts 75 on the table for the next meeting, then we are leaning more and more and more towards a policy mistake, using the interest rate to fix a large part of inflation that is going to be interest rate insensitive, which means they won't know when to stop. And that's it for the week.